Yes. So we have Anurag Singh, who is joining us today from US. He's an emerging market fund manager and runs his own firm and fund. Is joining us. Anurag, thanks very much for your time. When we look at Indian markets, it is being pretty resilient compared to many others. Investors have been specifically punishing to US markets this year. But talking of India or emerging market setup, you are of the belief that this, the rally which we are seeing is actually a bear market rally and may not sustain. What are the factors which make you so benign?
Look, here is how I see the things as of now. I see there are four major headwinds that are facing the markets. And when we come to Indian market, there is a fifth headwind as well. So the four major headwinds are as below. One is there is very high inflation, at least in US and all the Eurozone and even in India. So Fed is trying to raise rates. So one is we have a cycle which is of a rising interest rate. Second is that there is a quantitative tightening in US and I think across the world governments are trying to come off the ramp of the COVID hikes. So all the loose monetary policy, which eventually flowed into the assets, caused certain asset bubbles in certain places, that's also coming off. Third is rising oil. And consistently, I think while not getting lost in the daily news, the view is that there is going to be, if you're going to cut off Russia, there is going to be a shortfall in supply of oil and energy. And that shortfall is not being coming or compensated from any place else. So it has to basically come from demand destruction, which is the third pointer. And fourth is, Ajay, which makes it very interesting and which is kind of very different from some of the other bear markets we've had, which is that markets already are at a very high and rich valuations across the globe. They were, at least the US has taken a sizable correction now. But usually, if there is a combination of these four things, Ajay, I find it very difficult how markets can rally from here to any extent. There is a fifth headwind I spoke about, which is more particular for emerging markets. And that is the dollar appreciation. And, because there is a money flight back to safety. So money tries to come back to US Treasury. And that also causes dollar to appreciate. What it does is that eventually, even though Indian market might be giving returns, the net of dollar averaging returns for the investors, foreign institutional investors, actually take a beating. So with these kind of strong 4 or 5 headwinds, I really found it very difficult for last at least 3-4 months that how any market can kind of begin to rally from. At least these scenarios, historically, no market has rallied.
Right. Talk to us, Anurag. How are you really positioning your own portfolio in this kind of light? Are you having long short or are you building more defensive kind of positions in your own portfolio?
I do not, I'm not a big fan of shorting the stocks. And I think because usually there are more downsides than to an upside. So we are a long only fund. How we going about it is that Ajay, somewhere around Feb and March, we've gone about 40 to 50% cash. First it was 40% cash and eventually by March, we were 50% cash. Rest of the 50, Ajay, we were deploying into financials because they do well as the interest rates rise. Then we took some positions in energy. And then there were other consumer discretionary where we've taken a beating with other markets. But what notable point which I try to do is that I was trying to get off the technology ramp, which is because, if you see the last 5 years here in US, the big tech has, while they had earnings, but, take for example, Microsoft, it hit a high valuation of just like a 47, 48 price earning multiple. A stable company with that kind of a multiple kind of looks very unlikely to sustain. Similarly, Apple, it had touched a between 30 to 35 price earning multiple. So I think all these big techs, top 10 companies, which were basically propelling S&P and they constituted at their highs, 30% of S&P was coming from these top 10 companies. We were off the ramp. So broadly, Ajay, that's how the allocation looked. Of late, I think what's also doing well is healthcare and utility. So I think these companies normally nobody looks at, but healthcare is something that you can't cut back and it grows at a stable pace. Similarly, utilities, they give you a regular dividend yield. So I think that's where some of the money can be parked for the time being. Although I think because in a hedge fund, it allows you to go in cash whenever you want to, unlike mutual funds who have to be more or less broadly invested. I think it gives us a bit of a flexibility to park the funds and keep and stay in cash also, as long as the headwinds don't abate.
Anurag, talk to us about this energy bet of yours, which you are saying you have raised your portfolio. Because if even right now, if you look at Reliance Industries, it is gaining over 3.5%. Other energy stocks are also gaining. You've been raising your portfolio bets in energy, and now there is OPEC meet today. What was the reason that you raised? You thought you had made this call earlier, or what? That renewables actually may not be scaled up. Actually, we'll have to come back to fossil-related fuel demand, which is actually being seen right now everywhere across the world.
First of all, I don't want to be wiser after the event. I mean, I must say that we have taken some beating, right? Aside of taking first 40% cash out and then a little bit later gradually, but we have really taken a beating because recession fears were emerging here in US. So banks have taken a beating. So we are, on the balanced portfolio, we are definitely about 20% down on the 50% that is already invested. But I think in this market, if that comes along, then I think one should take it. But I think with that said, Ajay, on energy, I think we have never taken a very bullish position on renewables. Look, I think in these markets, and I think Indian markets, we've also seen this frenzy played time and again. And I think every bull market comes with its own flavors. I think renewables is something which holds a promise, maybe 20, 30 years down the line, but currently they will not account for a substantial part of the energy that the world will consume. That is point one. Second is, even if there is a small component of 5 to 10% which might come from renewables, what is the valuation you are buying everything at? Eventually, Ajay, we come from the school of thought that valuation is kind of the essence of what you buy in the markets. It is less about what you buy, but more about what price you're paying for it. And that's the principle we live by. So we never overpay for those valuations. We've really stuck to the conventional energy sources. Also, Ajay, as the cycles turn, and I think we are a big proponent of studying and understanding the economics and market cycles. What we were trying to do is, because energy was kind of constrained to go, and they were kind of with the ESG theme coming in, these companies were kind of throttled and their growth was not really kind of coming up in a big way. And when that happens for a decade, I think it is always ripe for a bounce back at some point in time. And unfortunately, war kind of resulted in that opportunity for the investors to kind of take positions. Even early on, I think when the economy was getting heated up late in 2021, still there were signs that energy and metals might show a revival. And I think that always happens, Ajay. I think the stock leadership of a decade usually doesn't really go for 2-3 decades altogether. If you study all the decades, I think there are commodity cycles and there are technology cycles and there are the discretionary cycles. So I think it just kind of leadership keeps changing. And even now, I think we are hoping that market will not bottom out until this leadership handover really, the leadership really changes from big tech to other players in the economy.
All right, Anurag, thanks very much for joining us today and sharing your perspective on investing. Let's take a